Hello and welcome everybody to today's edition of Mexico News Network's Breaking News Business. I'm your host, Elliot Bullman. Remember to follow us on all our social networks and to catch us every day by logging onto our website, mexiconewsnetwork.com, for relevant stories and news. Let's start with today's show. Last week, the White House backed away from an administration letter to key members of Congress, suggesting that President Donald Trump is softening his protectionist stance on NAFTA and instead seeking modest changes to the trade accord. The draft renegotiation plans, circulated in a letter from acting U.S. Trade Representative Stephen Vaughn, would leave in place controversial pieces of the trade pact with Canada and Mexico, including an arbitration panel that lets investors bypass the court system to redress claims under the pact. NAFTA is, of course, what the frequently hyperbolic president not too long ago vilified as the worst trade deal ever signed by the United States. To his way of thinking, what made the two-decade-old FTA between Canada, the United States and Mexico so onerous was job losses to Mexico. Still, Vaughn said in the letter that the US will seek authority to reimpose tariffs to protect industries at risk of serious injury from trade with Canada or Mexico. Trump is preparing to trigger a renegotiation of NAFTA. The president must first consult with Congress before issuing a formal 90-day notice of his intent to revisit the deal. But the administration so far has been vague about what the US will seek from Mexico and Canada in the talks. Moving on. Mexico enjoyed a trade surplus of $684 million last month, compared with a deficit of $783 million in February of 2016, the National Statistics Institute said on Monday. The surplus reduced the deficit for the first 2 months of the year to $2.61 billion. Petroleum exports rose 69% to $1.91 billion, while imports of natural gas and petroleum products rose 65% to $3.05 billion. State oil company Pemex exported 1.217 million barrels a day of crude oil in February, up from 1.085 million in January. The average price per barrel at $45.16 was similar to January's level, but well above the $24.48 price in February of 2016. February's $1.15 billion deficit in petroleum products was offset by a $1.83 billion surplus in non-petroleum goods. Auto exports rose 4.9% from a year earlier and contributed to the 5.5% increase in overall exports of manufactured goods. Imports of goods used in production processes rose 3.2% from a year before, although Mexico bought less equipment and machinery from abroad, and a weaker Mexican peso continued to weigh on imports of non-petroleum consumer goods, which fell 6%. United Bank of Switzerland said that they think negotiations between Mexico and the United States on issues such as trade, immigration, and security are now likely to be more conciliatory, potentially paving the way for further gains in the peso. In other news, the Board of Governors of the Bank of Mexico made its second adjustment of the year to monetary policy, in which it increased its benchmark rate by 25 basis points to 6.5%. Banxico's announcement is in line with market estimates, which envisaged this increase. This level of interest rates had not been seen since April 2009, when the country faced a financial crisis brought on by the collapse of US junk bonds. With regard to inflation, Banxico recalled that it has continued to rise, standing at 5.29% during the first half of March, mainly due to the impact of rising energy prices, and expects to maintain that trend during the year and yield to the end of 2018, when it expects to reach 3%, within a range in which the bank feels more comfortable. The objective rate of Banxico sets the interest to be paid on short-term loans. This measure is one of the tools that the institution has to control inflation, the main mandate of the Mexican Central Bank. As the rate rises, credits, consumption, and physical investments are discouraged, but it drives savings. In addition, foreign capital sees that Mexico is more attractive to the payment of higher interest rates, and this avoids further depreciation of the peso due to the right of capitals. During 2016, the institution, ruled by Agustin Carstens, raised its interest rate 5 times in its attempts to control the exchange rate and avoid a transfer to its inflation target. The most recent move, and the first in 2017, was on February the 9th, when it raised its interest rate by 50 basis points to 6.25%. And finally, let's take a look at the markets. The Mexican peso increased 0.84% to 18.86 from 18.7 in the previous trading session. Historically, the Mexican peso reached an all-time high of 21.92 in January of 2017 and a record low of 0.01 in May of 1972. IPC Mexico increased 0.57% to 48,819 from 48,542 in the previous trading session. Historically, the Mexican stock market IPC index reached an all-time high of 49,339.24 in March of 2017 and a record low of 14,008.2 in August of 2005. This was all for today. Thank you for staying with us. I'm your host, Elliot Bullman. Remember to follow us on Facebook, Twitter, and Google+, and log on to MexicoNewsNetwork.com for more information on Mexico and the world. Until next time.